have a couple of reactions coming in as well. We have
Dr. S. Narayan.
We have Mr. S. Narayan joining in. Mr. Narayan, just coming to you with regards to your first reaction on this, can you give us a sense in terms of the statements that they've made? The government expects GDP at 5.5%. They expect the government revenue projection is over-optimistic at this point in time.
I think this was something which was anticipated even when the finance minister presented the budget in August, because with a low GDP growth rate, and the industrial production levels not really giving you the numbers that they expect, it was a bit optimistic to expect the revenue projections to be there. But we were hoping that the disinvestment receipts as well as the cut down in expenditure will improve the fiscal balance. But yeah, the revenue is certainly a big over expectation.
Okay. Good afternoon, Dr. Narayan. Thanks for joining in. What's your, we got another slightly unusual statement. I didn't know I don't remember mid-year economic review saying interest rates expected to remain unchanged till March quarter end. How are the mid-year economic reviews written? The finance minister would have been the author of the statement. This has been written with his full knowledge?
Yes, this would have been written with the finance minister's full knowledge, yes, okay, that is true.
This is a very magnanimous...
Normally the finance minister would not normally comment on the interest rates unless the RBI has specifically shared it with him, shared its policy with him.
Well, that's possible. So, the RBI in its last policy gave us to understand that they could have reasons to cut the interest rate in the first calendar quarter of 2015, provided the numbers were to their satisfaction, and that it need not necessarily be in a policy, it could also be between policies. So now with the finance ministry's document saying, or the government's document saying that a rate cut is not expected until the end of the March quarter, is it safe to assume that the RBI would have shared that it could be in early April? Which is, there is a routine policy. Is that how we should read it?
This is a good question, because I think the market and the industry is expecting that there should be some movement downwards in the interest rates even as early as January or February. And you can already see that the banks have started factoring this into their fixed deposit rates, into their lending policies, etc. But if it actually happens that the rates don't go down, then even I think the financial institutions would be taken a bit by surprise, because they have already factored in a lower rate here. So I am a little, I would use even the word anxious, that there should not be a disjoint between what the Reserve Bank is doing and what the Finance Ministry is saying. I think there should be better coordination in their state.
It's a pleasant disjoint that the government is not pressuring the Reserve Bank into hastening the process.
Yes, I think the government is actually looking at looking at really the overall situation and saying that is the interest rate reduction warranted now, or is warranted a little later, when you are more confident about the inflation. You see, what has happened, if you look at it, what has happened in the last 1 week is that suddenly the rupee has depreciated very sharply against the dollar, which means that money is flowing out. I mean, this would also finally fuel inflation, isn't it? Yeah.
Okay. We have Mr. Soumya Ghosh, the Chief Economic Advisor of State Bank of India, joining in as well. Soumya, coming to you on this, just wanted to ask you about the fiscal deficit target. With the fact that maybe the tax revenue is not expected to be as robust, divestment is not kicked off as per expectations, do you think that the 4.1% is under threat quite considerably now?
See, in any case, the 4.1% target is already under threat, but I think that the end the government may just able to manage out the 4.1% deficit because of the fact that if there is even if there is a marginal slippage in the deficit, and please also note that there is another factor involved over here, the nominal GDP growth rate. which was supposed to be at 13.4%, I think, in the budget. So that is also going to be significantly on the lower side. So in that case, the government is also hard-pressed on that front, because the numbers as a percentage of GDP could also be on the higher side, even if suppose the absolute fiscal deficit number of 5 lakh crore is met into. So I think there is indeed a pressure on the fiscal deficit, but at the end I believe that the government could just wriggle out of the situation with more expenditure cuts in the next 1 or 2 months.
Okay, well, the other statement, Soumya, that's come from the government, the one that is least startling is the GDP is expected to be 5.5%. Do you think they will make it to that number as well, because you are expecting these planned expenditure cuts?
Yeah, I see that there may be a little bit of downside to the GDP growth rate, that because the first half growth rate has been 5.5%, and that has been purely because of the surge in the government expenditure. And the second quarter, the third and the fourth quarter is going to be a little better, not the third quarter per se, but the fourth quarter. And the bad thing over here is that if you actually look into the service sector growth rate, that growth rate may slow down a bit, because there has been a perceptible slowdown in the deposit and credit growth rate, which has not been reflected in the second quarter numbers. The third quarter agricultural growth rate could be on the lower side, because most of the production data is mapped onto the third quarter, and it is possible that some of the second quarter numbers which the agricultural growth rate showed a lot of traction could be because of the first quarter numbers being mapped into the second quarter. So from that point of view, the agricultural growth rate from here onwards will be weak. The industrial growth rate for the third quarter could be a little,
Okay, no, please,
I
please.
think there is a downside to the 5.5%.
Okay. No, I just wanted to know, what did you say earlier about the fiscal deficit? There is a statement says that the fiscal deficit target is in line with the strong fiscal responsibility of the government. When they make an on-the-table statement like that, they do expect to stick to 4.1, isn't it? Would you doubt that?
No, I agree with you to some extent that there is a pressure on the fiscal deficit number, and I think 4.1% at the beginning of the year was a little bit aggressive, because the market had already factored in at that point a deficit higher than 4.1. So my point, 4.1% target is challenging, and it will completely play out how the disinvestment proceeds spans out over the next 1 or 2 months, because I understand there has been a lot of pressure on the disinvestment receipts if the news reports which are coming to be correct.
Okay, Mr. Narayan, just wanted to come to you with the same, with the same question. Do you think 4.1% would be achievable for this government, and would it be achievable by cuts in planned expenditure and maybe further cuts in non-planned expenditure?
Let us look at the positives. The big positive is that the subsidies on the fuel side will be much lower than expected. And also that disinvestment receipts are hopefully going to be quite comfortable. But on the other side, they must make sure that the disinvestment proceeds process goes through very quickly, because there isn't very much time left, and the market is becoming a little bit volatile. It is not as steadily on the upswing as it was even a couple of months ago. So it's becoming volatile, and they should take advantage of the high market rates to do their disinvestment quickly. If they do that, I think 4.1% is still achievable. But I always have a point for the media here. Please, this 4.1% is a number that government always announces on the 31st of March. The reality really is when the accounts are actually settled, it's about September, October. That is when you really know whether 4.1% has been achieved or not. What is said in the budget and what is said on the 31st of March is not necessarily the final fiscal deficit number.
Okay. All right, Dr. Narayan, thank you very much for joining us with these initial comments that have come in from the mid-year review. We haven't got anything dramatic or startling, except an admission of the inevitable that tax revenues are going to disappoint, and that GDP growth would be likely around 5.5. So nothing very dramatic has been revealed just yet. We will have to await and see whether more details will come in when the document is out in the public domain. I guess only the interest rate revelation is something of an item I'm not able to handle at this point. So I want to get my hands around it. It's extremely magnanimous of the government to make such an admission, and I've not seen it in previous policies. Yeah. So that's welcome.
Well, and there's no change or nothing dynamic happening in the markets either, Lata. So the Nifty is absolutely static at 8236, no reaction, and wasn't really expected to have a reaction to the mid-year economic review. The mid-cap index is holding with a gain of around 0.8%. The 10-year too is quite static at around 7.93. But Soumya, we'll thank you on that note for your thoughts and for joining in for the mid-year economic review. But let's get a quick market opinion in. We have Deven Choksey, MD of KR Choksey Securities, joining in. Deven, hi, thanks very much for joining in. Your thoughts on the stability that we've shown, and any surprises in the mid-year review that you were expecting?
Well, not much, I think. Honestly, I think not much of surprises. I think most of the statements which have come up are the statements of facts, and I think they've been known probably. Yes, I think one thing could possibly mean as an outcome out of this particular commentary would be the government's efforts to probably, I think, accelerate this investment. Whether they could do it or not, I think that would be a question mark given the kind of a problem with the oil business right now. But the fact is that I think this is one particular message which is coming out loud and clear, that is they do want to meet the fiscal deficit. Then other parameters not coming in favor, I think they will have to resort to the divestment program. And that's something which I think the market would take a note of.
Okay, Deven. Thanks a lot.